Welcome to enrichminds.com and our session on the psychology of investing. In our session today, we shall study the impact and importance of psychology on investing decisions. If we understand our own behavior and that of others, and the psychology behind such decisions, we can profit from it. We shall be aware of the behavioral patterns and can make smarter decisions. If you recollect, behavioral finance is the study of the effects of psychology on investors and financial markets. It focuses on explaining why investors often appear to lack self-control, act against their own best interest, and make decisions based on personal biases instead of facts. In this session, we shall learn about some of the most common pitfalls and how to avoid them. Let's dive in. So, what is behavioral finance? Behavioral finance is the study of psychological influences on investors and financial markets. At its core, behavioral finance is about identifying and explaining inefficiency and mispricing in financial markets. It uses experiments and research to demonstrate that humans and financial markets are not always rational, and the decisions they make are often flawed. If you are wondering how emotions and biases drive share prices, behavioral finance offers answers and explanations. Behavioral finance originated from the work of psychologists Daniel Kahneman and Amos Tversky and economist Robert J. Shiller in the 1970s to 1980s. Daniel Kahneman and Amos Tversky are shown here. They applied the pervasive, deep-seated, subconscious biases and heuristics to the way that people make financial decisions. At about the same time, finance researchers began to propose that the efficient market hypothesis, or EMH, a popular theory that the stock market moves in rational, predictable ways, does not always hold up under scrutiny. In reality, the markets are full of inefficiencies due to investors' flawed thinking about prices and risk. We encourage you to study behavioral finance in detail if you are interested, but we shall cover the basics of 6 theories in some detail in the session today. Number 1. Prospect theory. Prospect theory says that investors value gains and losses differently, placing more weight on perceived gains versus perceived losses. An investor presented with a choice, both equal, will choose the one presented in terms of potential gains. Prospect theory is also known as the loss aversion theory. The key premise of prospect theory, Tversky and Kahneman's most important theoretical contribution, is that choices are evaluated relative to a reference point, i.e., the status quo. The second assumption is that people are risk-averse about gains relative to the reference point, but risk-seeking about losses. What that means is that we hate a $100 loss way more than we value a $100 gain. We feel losses a lot more than we experience gains. Human beings are more sensitive to getting hurt or hate losses than they are to gaining happiness or making profits. This aversion to losses keeps us away from experiencing gains in the longer term. Let's watch a short video on loss aversion.
A 1995 study of Olympic medal winners found that bronze medal winners seemed on average far happier than silver medal winners. The reason has to do with perceived gains or losses around a reference point. The silver medalist focus on almost winning gold with any other outcome considered a loss. The bronze medalist focus downwards towards fourth place and not winning a medal at all. Therefore, any outcome above not winning a medal is a gain. That's why some silver medalists have this irrational reaction. They should be happy at being second best in the world rather than being first loser. Prospect theory explains that we process information in an illogical way by valuing gains and losses differently. Expressed in financial terms, the amount of joy gained from receiving $50 should be equal to a situation in which you gained $100 and then lost $50, as both results in a net gain of $50. But most people view the single gain more favorably than the gain and loss scenario, because the feeling of pain due to a loss is 2 to 3 times greater than the joy felt from an equivalent gain. Loss does hurt. But get some perspective. Enjoy the wins too.
The second theory is called anchoring. Anchoring bias occurs when people rely too much on pre-existing information or the first information they find when making decisions. For example, if you first see a t-shirt that costs $1,000, then see a second one that costs $400, you're prone to seeing the second shirt as cheap. But without the first t-shirt costing $1,000, you would have thought that $400 is too much money to pay for a t-shirt. Your views and thoughts were anchored by the earlier $1,000 t-shirt. Marketers exploit this idea all the time by showing markdowns and pricier options next to other still pricey options to choose from. Anchoring is the subconscious use of irrelevant information, such as the purchase price of a security, as a fixed reference point or anchor for making subsequent decisions about that security. Let's watch a short video on anchoring.
Anchoring is the tendency of an investor to become attached to information that might not be accurate or relevant. For example, an investor might see that a company's stock has fallen considerably. This investor might be anchoring on a recent high achieved by the stock and believe that the drop in price is an opportunity to buy at discount. While this could be true, it's also possible that the stock has declined due to a change in underlying fundamentals. For example, the share price could have risen due to strong revenue last year, but now a major customer could have decided not to renew its purchasing agreement with the company, causing the share price to drop. The investor might believe the stock is undervalued because he's focusing on the previous high, not looking at the real reason for the fall in price, and now finds himself falling prey to anchoring.
The third theory is called overreaction bias. Motivated by psychological and experimental studies on overconfidence bias, several theoretical and empirical studies showed that overconfident investors overreact to their private signals and therefore trade excessively, causing price deviation from rational levels and excessive return volatility. We have seen these kinds of overreactions over and over again. During the late 1990s, with the internet bubble, and more recently, the hype behind cryptocurrencies and bitcoins in particular. Overreaction occurs on both sides. Excessive greed creates bubbles, and excessive fear causes crashes. Let's watch a short video to better understand this idea.
On the stock market, investors often overreact to new information, which has an exaggerated effect on a stock's price. A study in 1985 saw securities on the New York Stock Exchange separated into the 35 best performing stocks and the 35 worst performing stocks. Both groups were monitored over 3 years and the results were surprising. The so-called worst performing stocks consistently beat the market index, and the so-called best performing stocks consistently underperformed. The winners had become losers and vice versa. Why? With the loser stocks, investors had overreacted to bad news and driven prices down. Later, upon further assessment, they realized that they'd overreacted and the stock prices rebounded. The same thing happened with the winning stocks, because investors realized they were a little more excited than they should have been. And don't forget the important role played by availability bias. People generally weigh their decisions heavily towards recent information, forgetting potentially important news from the past. And remember, that initial feeling doesn't always last.
The fourth idea is confirmation bias. Drinking one's own Kool-Aid, they say. That is confirmation bias. A confirmation bias is a type of cognitive bias that involves favoring information that confirms previously existing beliefs or biases. For example, imagine that a person holds a belief that left-handed people are more creative than right-handed people. He then finds all the smart people who are left-handed and then decides that his belief must be true. He is only confirming his beliefs and nothing else. This is very risky while investing. We must avoid it. Confirmation bias is the tendency to search for, interpret, favor, and recall information in a way that confirms or supports one's prior beliefs or values. People display this bias when they select information that supports their views, ignoring contrary information, or when they interpret ambiguous evidence as supporting their existing attitudes. Confirmation bias cannot be eliminated, but it can be managed, for example, by education and training in critical thinking skills. Let's watch a short clip to better understand confirmation bias.
It's often said that seeing is believing, but what we see may not always be a true reflection of reality. Sometimes we only see the things we choose to see because they support our opinions. This is called confirmation bias and can lead to the dangerous mindset of overconfidence. An investor might be more likely to look for information that supports his original ideas about an investment, rather than look for information that could contradict it. For example, an investor might hear about a hot stock from a friend at a barbecue or overhear a conversation at work, so he researches it to prove its potential is real. His eyes are open to the green flags like growing cash flow and low debt-equity ratio, but he ignores the red flags, such as dwindling markets and the loss of critical customers. It can be difficult to encounter something without having a preconceived opinion. This first impression can be hard to shake because of confirmation bias. Never be afraid to challenge yourself. Better yet, get someone else to challenge you.
The fifth important idea is gambler's fallacy. The classic example of the gambler's fallacy occurs when someone flips a coin. If the head lands face up, say 4 or 5 times, most people will believe that the coin will land on the tail side next time, occasionally even arguing that the repeated heads coin increases the likelihood of a future tails coin. What is the gambler's fallacy? The gambler's fallacy, also known as the Monte Carlo fallacy, occurs when an individual erroneously believes that a certain random event is less likely or more likely to happen based on the outcome of a previous event or series of events. Just because the share price of a company has gone down significantly does not mean it is likely to go up now. Or just because the share price has gone up significantly does not mean it is likely to fall soon. Please do not fall into this very common trap while investing your money. Let's watch a short clip to better understand this idea.
Gambler's fallacy is an incorrect assumption that a random event is more or less likely to occur after another event or series of events. For example, 20 coin flips have all landed head side up. The next flip is more likely to be tails, right? Wrong. Every coin toss is an independent event with a 50% probability of landing on heads, regardless of what's happened in the past. In the same way, a slot machine will not eventually hit the jackpot if a gambler plays on it for hours and hours. The probability of winning is the same on each play. He may believe he's getting closer to the jackpot, but he isn't. Some investors liquidate a position after it goes up, because they believe it can't possibly continue to go up. Others hold on to stock that's fallen because they believe it can't possibly decline any further. Investors shouldn't base decisions on gamblers' fallacies, but rather on fundamental analysis. Because each event is independent and the past doesn't change the probability of future events.
Last but not least, the sixth theory is herd mentality bias. Herd mentality, mob mentality, or pack mentality describes how people can be influenced by their peers to adopt certain behaviors on a largely emotional rather than rational bias. When individuals are affected by mob mentality, they may make different decisions than they would have individually. The tendency of the people to think and behave in ways that conform with others in the group rather than individual. Stock investors, riveted by market gyrations, need to resist emotional responses and the herd mentality when investing. But understanding this concept can also offer great investment opportunities to the smart investor. It is almost always better to avoid the herd. After all, Warren Buffett can't be wrong when he said, "Be fearful when others are greedy, and be greedy when others are fearful." Let's watch a short video to better understand this idea.
Herd behavior is our human tendency to follow the crowd, leading us to make decisions we might not have made if we were alone. It often comes down to social pressure, the need to conform and avoid being an outcast. It's a belief that so many people can't be wrong, and maybe they know something we don't. Just look at the bursting of the dot-com bubble. Investors sank their money into internet-related companies, even though many didn't have sound business models at the time. Every time there's a new investment fad, financial professionals are put under pressure to follow the herd, and it's easy to see the temptation. Because if it works out, everybody's happy. If it doesn't, well, everybody else was doing it anyway.
In summary, now let's look at the key takeaways. First, human psychology plays a big role in our investment decisions, and that of others too. So if we understand these concepts, we shall be able to avoid making mistakes and also make better decisions. And always invest sensibly, suitably, and simply. Thank you for your time. Until next time then, stay enriched and strong.